Welcome back. Welcome back, matriculants. This is chapter 1, lesson 4. Remember that in chapter 1, we were all about accounting concepts. We discussed a lot of accounting concepts, from definitions of primary concepts in accounting, the rules of debit and credit, and how to classify accounts in accounting. Now we're in the stage of recording those transactions. When you know what an account is, when to debit it and credit it, and how to classify it, you should be able to know how to record it as well. So in today's lesson, which is our last lesson in this chapter, we're going to learn how to record transactions in an accounting equation, and you'll also learn how it applies to accounting, financial statements. It does not only, the knowledge that you are going to get here does not only apply to accounting equation, even though the emphasis will be on the accounting equation, but you'll gain an understanding of how to apply it in when preparing financial statements, your income statement, balance sheet, and the cash flow statement. So we have a 5-step approach to identifying transactions, to recording a transaction in a financial statement or the accounting equation. So the 5-step approach goes like this. But let me first emphasize this. When practicing right now before exams, yes, do these things in step by step. But it becomes natural. It is going to become natural to you when you do more and more practices. You will not have to manually go through these steps when you have practiced more. So the solution here for you is to practice more and more examples using this 5-step approach, so that it becomes natural. Because if you try to follow these steps manually, writing everything down in an exam situation or a test situation, you're going to take very long to complete your solution. So practice more and more examples so that it becomes natural, so that whenever you read a transaction, you already know that, okay, the two accounts affected here are this one and this one. You do not have to write down, and this one is going to be debited, this one is going to be credited, this one falls under, is an expense, this one is an asset. So it just has to come natural to you without you thinking of the step-by-step process. Yes. So practice more so that it becomes a part of your nature. So yeah, let's go on. So the 5-step process starts with you reading the transaction given. For example, here they say that the business buys stationery and pays by check. It could be a check, it could be EFT, however the payment method. And then read the transaction. After reading the transaction, then let's move to the next step. The next step is to identify 2 accounts affected. Remember that in accounting, every transaction affects at least 2 accounts. There will always be 2 accounts affected. There's only one transaction that has 4 accounts, that affects 4 accounts, and that one is the sales account. It affects the sales. It also affects bank if it's a cash sale. It also affects trading stock and cost of sales. So 4 accounts, but the rest affect 2 accounts, at least 2. So identify the 2 accounts affected. Remember that chart of accounts from our previous lessons. That chart of accounts which shows a list of assets, a list of income accounts, a list of expense accounts, and a list of liability accounts. So we are talking about those accounts. Those are accounts. So identify the two accounts affected. So in this transaction, we've identified that they have bought stationery. So one account will be obvious on the transaction. It will be obvious to identify it. And then ask yourself, how was this paid for? Was it paid by cash or on credit? Then because it was paid by cash, then the bank was affected. Bank account was affected. So the two accounts affected is stationery and bank. Two accounts affected. And then step 3, move to step 3. You move to step 3 and then you ask yourself, okay, what type of accounts are these accounts? What type of an account is stationery? What type of an account is bank? And then remember the acronym, the ALUI. Any accounting should fall under one of these elements, under one of these type of accounts. It cannot go outside of this, otherwise it is not an accounting transaction. So classify it as whether it is an asset, liability, equity, income, or an expense. And then in our example, so a stationery is an expense account. I hope that by now you know this by heart, that when you see an account which is stationery, you already know that is an expense. You don't even go through the definition of what an expense is. Bank, you know that a bank is an asset account. And then decide which one is going to be debited and which one is going to be credited. So you ask yourself, is this stationery account increasing or decreasing? Is this bank account increasing or decreasing? And when an expense increases, do we debit or credit? When an asset increase or decrease, do we debit or credit? So that is the question you should ask yourself. Is the expense account increasing or decreasing? It's increasing. What happens when these accounts increase? Let's just go back a little bit. So you ask yourself, what happens when an asset increases? Okay, in our case, the asset is decreasing, which is the bank. So we credit it. And what happens when an expense increases? Because our stationery is increasing, we're buying more stationery, we debit it. So it's very important to know this mnemonic. Yes. And then last step, you're going to record the transaction. Like I said, that your accounting equation is actually your income statement and balance sheet. So when you know where to classify accounts on your accounting equation, you will obviously know when to classify them in your financial statements, income statement and balance sheet. So the last step is to record the transaction. And then you say that, okay, an asset decreases by 150 and owner's equity decreases also by 150. So that your accounting equation balances. Okay, and the reason why owner's equity is decreasing is because owner's equity, expenses reduce owner's equity. They reduce profit, so they reduce owner's equity. Yes. And remember that I've said that when we talk about owner's equity, we're talking about income and expenses. And income increases owner's equity, expenses decrease owner's equity. Yes. And then here's an example of that stationery purchase. You purchase stationery with a value of 150. So the money in the bank decreases, and we decrease the owner's equity. So if we need the formal way, it will be plus 150 under the asset category here. Under here, it will be plus 150. Minus 150 is equals to minus 150 and then plus 0. That will be our full accounting equation. And then here's an example for practice, which demonstrates the 5-step process. So here's the transaction. The business sells goods for 1,000 rand cash. The business sells goods and the customer pays in cash. So 2 accounts affected is cash or bank and sales. And then you say, okay, cash. Remember that cash, the other name for cash is bank, né? And then you say, what kind of an account is cash or bank? It's an asset. And what kind of an account is sales? It's an income. But like I said, here we're just simplifying things. A sales account, a sales transaction affects 4 accounts. 4 accounts. So there will also be trading, inventory, and cost of sales. But let's leave them out for now, and then decide which account is debited and which one is credited. So you would ask yourself again, this cash account is the asset account increasing? Because we've already identified them as income and expense. You ask yourself, is the asset increasing or decreasing? Okay, the asset is increasing because we are receiving money. The asset is increasing, so we're going to debit it because assets increase on the debit side. And then you ask yourself, what about sales? Oh, sales is also increasing. More sales. For example, if we started the day with a sales figure of 1,000 and then we sell more goods, by the end of the day we have 2,000, then sales have increased. So, and what type of an account is sales account? It's an income. It's an income account, and income accounts increase on the credit side. So we're going to credit this account. It's a credit, and on the accounting equation is going to be plus 1,000 on the asset side, and then owner's equity also is plus. Remember that owner's equity comprises of income and expenses, and income increase. When income increase, they increase owner's equity, so it's going to be plus 1,000. Hence this increase 1,000, and then liabilities, no change. Yeah, so then go to your quiz. There is a quiz on this. Go to your quiz, do the quiz, and then you will master this lesson on the recording of transactions on the accounting equation. It's a very simple exercise, this one. It will become very natural when you do more and more examples. And for you, the matriculants, it must be natural already to you. You shouldn't be struggling with this. Unlike the grade 10s, we're just starting with accounting. So go and do the practice activity, the quiz. There's also a solution to that, and then see how far you know the this concept. Thank you. See you in the next chapter.